Going over IRS Form 5405, repayment of the first-time homebuyer tax credit. So for most taxpayers will probably never see this form, but if you purchased a home for the first time between 2008 and 2010, you might have been eligible to take a tax credit of anywhere between $7,500 to $8,000, depending on the timing, from your tax return for the year that you purchased the home. However, the tax code also made this a caveat. It wasn't a true tax credit in the sense that you never had to repay it back. So the way this tax credit worked was you took the tax credit in the year that you purchased your home, and then you had up to 15 years to pay it back. So if you took a $7,500 tax credit, you would, starting in 2010, you would pay back that tax credit, well, 1/15 at a time, or $500 per year for 15 years, unless you accelerated the payment and paid it back faster. So even though we're still 15 years removed from 2008, the payback period actually started in 2010, which means that there's another couple of years left on this IRS Form 5405 before it becomes obsolete. However, there are still people who either own their house or now are having to report the sale of their house or disposition for some reason. So this tax form is going to cover what happens when you either continue to just repay that credit, or what happens if you sell or otherwise dispose of your home, how you report that on your tax return. So this is a one-page tax form. It's in 3 parts. Part 1 is the disposition or change in the use of your main home for which your credit was claimed. Part 2 was repayment of the tax credit itself. Part 3 contains the gain or loss worksheet. So we'll walk through all 3 of these parts, but we'll also kind of lightly discuss some situations where you might not need to report all 3, or you might not need to complete all of 3 of those parts. So we cover all of this in great detail in our article, which is on our website. I'll get to that at the end of this video, but let's start with part 1. So at the very top, we're going to enter our hero's name, John Doe, as it's shown on his tax return, and his social security number. And then we're going to complete part 1, which is the disposition or the change in use of the main home. So if you still have it, then you don't need to complete part 1. Basically, you're only completing part 1 if you actually no longer use the home, if it converted to business use, or you made it into a rental property, in which case there are certain rules that apply, and we'll kind of cover those. So we'll pretend that this was the year that John Doe sold his home. So now this tax form just released in November of 2023. We're going to go ahead and pretend for this time frame that we're actually in the middle of tax filing season. So John is reporting that he sold his home on 6/30/2023, and that's in line 1. So in line 2, most people leave that alone unless you meet one of the criteria, which is you were a member of the Uniformed Services or the Foreign Service, or if you were an employee of the intelligence community. So, whether you work for the State Department, the Uniformed Services, which includes the Department of Defense, active duty Army, Navy, Air Force, and Marines, and Coast Guard. It also includes the Public Health Service and other services that wear uniforms. So in this, you can check it if you sold the home in connection with government orders for qualified official extended duty. So most military members would be familiar with permanent change of station orders or PCS orders, but it could apply to active duty reservists that have to relocate at least 50 miles away, and the orders are either written for a period of more than 90 days or for an indefinite period of time. So as long as you meet one of those criteria, that the federal government actually relocated you and you're one of these three community members, then you don't need to repay back that credit. You got the tax credit, great. You don't have to repay it back. Otherwise, you're going to go to line 3, and you're going to check one of these boxes. So in this situation, John Doe is completing box 3A, which means that he sold the house to a person that is not related to him and had a gain on the sale. So he needs to calculate the sale on part 3. Then he needs to report in part 2 his repayment for that credit. Now, I'll lightly discuss the other scenarios, but we'll go into more detail in the article. So 3B is basically selling the home to someone that isn't related, but you didn't have a gain. So you either broke even or lost money on the sale. In that case, you don't have to repay back the credit. If you sold the home to a related person or you gave it to someone, then you need to complete part 2 below. If you converted it to rental or business use, or you still own it but it's not your main home, then you would go to part 2. If you transferred it to your spouse or to an ex-spouse as part of your divorce settlement, you would include the full name of your spouse, and then the IRS recognizes that you no longer have responsibility to repay the credit if your spouse is the person that received it. So you would stop there. Boxes 3F and 3G have to do with destroyed, condemned, or selling under the threat of condemnation. 3F is what you would do if you realize a gain. 3G is what if you did not have a gain. And then finally 3H involves a deceased taxpayer. So again, we cover all of that in our article. For the purpose of this video, we're going to walk through the mechanics of if you actually just sold the home. So you need to calculate the gain in part 3. We're going to do that, and then we're going to skip down, and then we're going to complete part 2 last. So the reason we're completing part 2 last is because we actually need the gain on the disposition as part of part 2. So we need to figure that out. So in part 3, we're going to use this worksheet to calculate the gain or loss. And so you might use either IRS publication 523 that will help you determine the selling price of your home and expenses. If your home was condemned, you may need to use IRS publication 544, which is the sales and other dispositions of assets, to inform what you're going to put in here. We do cover the worksheet, IRS publication 523. There's another video that's on the YouTube channel. It's also embedded in our article, so you can actually watch that video to figure out how there's a worksheet in publication 523 that walks you through the adjusted basis aspect of selling your home, and then you would use that information to plug into these lines. So in line 9, you're talking about the selling price of your home or the total proceeds or whatever you were awarded because your home was condemned. So in this case, John Doe received $200,000. And then in line 10, we're talking about selling expenses. So he paid $15,000 in total selling expenses, which means he realized $185,000 from the sale of the home. Now, his adjusted basis is 174. We calculated that offline, but that's what I determined. Again, you would use the worksheet in IRS publication 523 or guidance in 544 to do that. So we came up with 174,000. He also had $1,000 remaining on his first-time home buyer credit. So he claimed $7,500. He's been paying this off $500 a year from 2010 to 2022. So that means he's got $1,000 left. It was $1,000 for 2000 or $500 for 2023 tax year, and $500 for the 2024 tax year. So he subtracts line 13 from line 2. Oops, sorry. I meant to work these figures so that we arrived at 175. So I apologize. I just readjusted the adjusted basis to 176. That way I can take out the home buyer credit, and then it gives us $175,000, which is the adjusted basis specifically for the purpose of repaying this credit. So we subtract line 14 from line 11, we get a $10,000 gain, which means we're going to check the box on line 3A, and then we're going to complete part 2. Now, if your home was destroyed, you would check line 3F instead of line 3A, and then you would complete part 2. But there's a specific rule that says you have 2 years from the date that your home is destroyed or you sell it through condemnation to find another home to continue repaying. So if you don't find a new primary home after 2 years, then you have to repay the entire credit. So this probably was more of a shock back in 2011 or 12 time frame. You know, now people would just look at an extra $1,000 on their tax bill, and it kind of stinks, but you know, $1,000 when you were going to pay $500 this year anyway isn't the biggest deal in the world. Now, if you realize a loss because of your sale or the condemnation of your home, then you can check either line 3B or line 3G, and you don't have to repay back the credit because you had a loss. So we had a gain of $10,000, and we're gonna keep that in mind when we go through this. So now we're in part 2. We claimed $7,500 back in 2008. And then since 2010, John Doe's been paying back $500 a year. So he's got $6,500 worth of payments. When you subtract that amount, that means he's got $1,000 left. We plug in the $10,000 sale or the gain on the disposition. And then now the instructions basically tell you that in this situation, you take the smaller of either the $1,000 or the gain. So if you sell the home and you realize a gain, then your paying back of the credit is limited to the gain on the disposition of your home. So if this disposition ended up netting $500, then that would be the limit that John Doe would have to repay. So this is the amount that John Doe does have to pay. He's going to put that here, close that out. He's also going to insert that in Schedule 2, line 10. That's the additional tax form. So any additional taxes that are calculated that don't have a natural home somewhere go on Schedule 2. So that's all we have for this video. Again, we do kind of break down a little bit more detail on some of these other scenarios in our article, which you can find on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 5405, and you'll see our article. And inside our article, you'll also see a link to the YouTube video where we go over the calculating the gain or loss on the sale of your primary residence. That's the worksheet 2 located in IRS publication 523, Selling Your Home. So if you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And as always, if there's any question that you have, if you have comments or questions, please post them in the comment section. If there's a specific topic or a tax form that you would like to go over, please feel free to scan our libraries either on YouTube or on the website. And if you don't find what you're looking for there, post that in the comments section, and I will do my best to get it on the editorial calendar in the near future. So that's all I have. Thank you very much and have a great day.